Hello, good evening, ladies and gentlemen. Welcome to our session today. Right, today I want to look at interpretation of financial statements. I think some of you just saw that you unfortunately made the topics whilst you were in the assessment. But I'm going to look at that. Some of the ratios, we'll look at them today, and then we'll finish off during the next week. My understanding is that the next weekend will be your last assessment. Correct me if I'm not, if I'm correct. If I'm wrong, can you correct me? Are we going to have our last
No,
assessment
you
next?
are correct, Eugene. It's the
Okay,
last
thank you
one.
very much. Okay. So normally the last assessment, they can ask on anything, including the things that we have already done. So please make sure that you review your work. And please make sure that at the end of the day, you review your assessments and see where you didn't understand and see if you can be able to do it. Unfortunately, I think you saw that I didn't send you the workings this time around because you would find that on the ratios, most of the things, I think there were mistakes there. I was just giving the best nearest solution, but otherwise, if you use the formulas that we were supposed to use, there was no answer for most of the things that were on the first part of the statement of cash flows. But I will make sure that I work on giving you the workings so that you can be able to review and see your understanding of the things. Right. So today I want to look at the interpretation of financial statements. Then next week we are going to move on and check some of the ratios that we have not done. Uh, right. The last assessment we will try to make sure that it is done maybe probably on time because I don't think that we should wait for Sunday. I will make sure that by Saturday latest in the evening I should have done it. Right. So now let's look at uh, interpretation of financial statements. Uh, Interpretation of financial statements. Right. So one thing that we should understand is that the financial statements on their own, by just looking at the figures, it might be very difficult to make sense of the information. So the interpretation helps us to make sense of what is in the financial statements. Right. I want to look at an example. Let's say we've got two companies. We have company A and company B. Right. Let's say their capital. We have here 200,000. And here we have got 1 million. Then let's say we've got a profit 40,000. Let me say right. With these two companies that we have, if I have to ask you which company performed better, what would you say? What would be your opinion? I'm asking, what would be your opinion there? if you were to be asked which company is doing well, company A and or company B. Any opinion, my friends? No opinion. Just tell us what you think.
Maybe company B.
Why?
Because or A, but it will be based on the sizes. So let's say if the capital was the size of the company B is like 5 times the size of company A, maybe it should be making 5 times profit also, but it's not.
Can you get what our learned colleague is saying there? I think she's very right. She corrected herself. In the first instance, if you just look at this, you would say company B is doing well, as they are making a profit of 120,000, whereas company A is doing is only making 40,000. But you should remember that company A only has a capital base of 200,000. So out of their 200,000, they are generating a further 40,000. Whereas out of 1 million, company B is only generating 120 million. So we can say, let's calculate what is called the percentage profit on capital. You'd find that so would say for the first one, would say 40,000 over 200,000 multiplied by 100. Then on B would say 120,000 divided by 1 million multiplied by 100. Right. At the end of the day, we can see that the percentage profit on capital is 40% here. It's what 20% here. And here it's 12%. So in terms of capital, you can see that as what our sister was saying, that this one is times 5. We're expecting it to make times 5 profit. Company A is actually making a profit of 20% on their capital, whereas company B is making 12%. So you can see that in terms of profitability, company A is doing well compared to company B. So you find that the figures in the financial statements, they don't give us a proper picture. So we actually use the interpretation through calculation of ratios to understand the performance of the business. All right. So we are saying ratio analysis can be used to assess the performance of the entity from different angles. Which includes comparing current year's performance to the previous year. So you can compare our performance this year to the previous year. We see what is our profit percentage, what is our current ratio, and stuff like that. Then we can also compare the performance of the company to industry averages. So one of the ways to measure yourself, your performance, is to compare your performance to what the industry is doing. For example, we know that the mining industry have what they call the Chamber of Mines, which groups all the mines together. So that organization will give what are called industry averages. that, for example, the profitability of an average company in the mining sector is 40%. So now we can check against ours to see if we're doing well, right? Then we can also check the performance of different companies in different industries. Under the same investor. Let's say an investor is invested into the retail sector and they've also invested into mining. They can compare to see what is happening, what are the returns in mining compared to those from retail. Then they will make a decision on which industry should they expand investments. So all these are ways in which we can use ratio analysis. Right. Ratios can be classified according to their categories. Right. We have got what we call profitability ratios. These measure the success of the entity in terms of its ability to generate profits. Right. There are various ratios that we can be able to use. Right. We can use the return on equity. Right. To calculate your return on equity. So this topic is all about formulas. You have to understand your formulas for you to be able to calculate it. It's profit before tax. Please, ratios are calculated in different ways for different modules. So don't be surprised when you go to a different module and you see that they are now saying a profit, a return on equity. Most modules, they say it's the profit after tax over total equity. But in this module, we use the profit before tax. Right. Then we have got a return on total assets. Our return on total assets, we have the profit before interest and tax multiplied by 100. Divided by the total assets. By total assets, we mean the current plus the non-current assets. Right. Gross profit percentage. Or it can be called a gross profit margin. Right. This one, it's our gross profit multiplied by 100 divided by the revenue. Or you can say over sales. All right. We've got the financial leverage. Which is a return on equity over the return on assets. Right. We have then profit margin. Of which we are going to have our profit before tax over times 100, but normally we know that it's profit after tax. So you can see that if you use this one in your assessment, you're not going to get the answer. So we had to shift to the one of using profit after tax. Right. So these are some of the profits that we call profitability ratios. Right. Right. Then number 2, we have what we call the liquidity ratios. This measure the ability of the entity to meet short-term obligations. As they fall to using short-term resources. You'd find that an entity normally meets its current liabilities using the current assets. So we'll be assessing that ability when we talk about the liquidity ratios. Right. We also have different ones here. For example, we've got what we call the current ratio. Right. Our current ratio is the current assets over our current liabilities. Right. We have asset test, which is also called the quick ratio. Right. With the asset test now, it assesses the ability of the assets, current assets excluding inventory, to meet short-term obligations. So it will be as the same as above, but on the numerator, it subtracts our inventory. Because this one, the argument for this ratio is that inventory may take time to sell. So let's assess the ability of the entity to meet its short-term obligations without considering inventory. So it excludes inventory from the equation. So it's just like the current ratio, only that it doesn't take the inventory into account. Right. Right. Then we also have trade receivables collection periods. This measures the number of days that it is taking for your customers to pay you. That is how long are they taking to pay their debts. Right. The average trade receivables. Over the credit sales. This one does not divide by all the sales, only credit sales. Multiply by the number of days in a year. But in another scenario, they can tell you that the days were 366. When they say average, that is equal to this year's figure. So for all the ratios that we talk about average, is this year's figure plus last year's figure divided by 2. That's average. So whenever we have a ratio that talks about average, you take this year plus last year, then you divide by 2. And you should be very careful that in some exams they get, or assessments, they can tell you that use closing balances. So if they say use closing balance, you just use the trade receivables for this current year without using the average. If they say use closing balances, you don't use the average. Right. We have trade payables settlement period. That is the number of days that it is taking us as the entity to pay our creditors. So this is now us now at the number of days that it is taking us to settle our debts. So this is average trade payables times 365 over credit purchases. So that's the number of days it is taking us now as an entity to meet our own debts. Right. We have inventory turnover period. The speed in which you are turning your inventory into sales. So this will be cost of sales over average inventory. Then we have F inventory holding period. That's the number of days that it is taking you to sell your goods. That is from the date that you buy them. So that's average inventory times 365 over the cost of sales. So these are what we call liquidity ratios. Right. Then after the liquidity ratios, we have what we call the solvency ratios. Right. The solvency ratio, this is the extent to which the business can continue operating and be able to pay long-term debts in the long run. Actually, we usually say that a business is not liquid if the current assets are less than the current liabilities. And we say it is insolvent when the liabilities are now more than the assets. Right. The ratios that we use in this module to assess this part, we use the debt to equity ratio. So the extent to which our business is funded by debt to the extent to which it is funded by equity. Total debt over total equity. Multiplied by 100. Right. Then next, we have got the times interest end ratio. Which is this is the extent to which our profits can be able to meet our debts. The extent to which our profits that we made can be able to meet our interest. So to what extent can our profits cover our interest? Right. Profit before interest over interest expense. Right. So these are the ratios that you're expected to know. Any questions? Right. Now I'll turn to the questions that I gave you. We'll be able to do part of them, then we'll continue and finish the rest when we meet. Right, the following information was extracted from the financial statements of Chakalaka and Sons for the financial year ended 28 February 2014. Right. Then calculate the following as a 28 February 2014 for Chakalaka and Sons. Assume 365 days in a year. So if they say assume 366, wherever we entering 365, you would then be using 366. Right, then the additional information. All sales and purchases for both years were on credit. The debt to equity ratio of Chakalaka and Sons was calculated as 50%. So the debt to equity is given, it's 50%. The long-term loan was acquired on 1 January 2014 and is repayable in full on 31 December 2016. All right, calculate the following ratios. Now they've got the one for 2014. So I will just do the 2014 one, and then you can try to do the 2013 wherever it is possible. All right, 2014 number A, current ratio. Right. Number A, Current ratio. Remember, current ratio, we said current assets over current liabilities. This one here. Right. So now we'll go and identify the current assets and the current liabilities. We get them in the statement of financial position. The statement of financial position is the one that has got current assets and current liabilities. Right. Now, my friends, we use our knowledge of the statement of financial position. We know that inventory is a current asset. Trade and other receivables, current assets. Cash and cash equivalents, current asset. Unless if it's negative, it becomes a current liability when it becomes an overdraft. Right. Trade and other payables, this is the current liability. Property, plant and equipment, we're not going to consider that. That's a non-current asset. Bank overdraft, it's a current liability. Capital, it's equity. Long-term loan is non-current liability. So those are the 5 items that we need. So add the inventory, trade and other receivables, and the cash and cash equivalents. That's our current assets. Then we'll also add the trade and other payables and the bank overdraft. That's our current liabilities. So we're going to say the current assets, I will have my inventory 122,000 plus trade and other receivables 171,500 plus our cash and cash equivalents. Okay, there's nothing on the cash and cash equivalents, so that's it. Then we come on our denominator, the current liabilities. We have trade and other payables, which is 119,000 plus our bank overdraft, which is 40,000. What do we get? I'm waiting for you guys. Just give me your answer to 2 decimal places.
I got 1.85 for the final answer.
Thank you. That's what I want. So what does that mean? That means for every 1 rand of current liabilities, the company has got 1.85 rands of current assets. So that means currently it can be able to cover the current liabilities because its current assets to current liabilities is more than 1. In some industries, they say an average of 2:1 is safe. Okay, just give me a minute. Sorry, guys. All right. So that means this entity is able to cover current liabilities. If it becomes less than 1, it becomes worrisome. But for us to make a proper comment, we would need to know the industry averages, which we don't have now. Right. Right. Then we have the next one, trade receivables collection period. Right. Trade receivables collection period. That is the number of days that we are taking to recover money from our customers. Right. Remember, it's the average trade receivables. So our average trade receivables will take these two, add them together and divide by 2. And our revenue is this one. We wanted the credit sales. We're told that all sales were on credit. So we'll take all of them. So we would say average receivables 171,500 plus 79,000. Right. This divide by 2. Then we multiply by 365. Then we divide by the sales, which are 310,000. What would we get? I'm waiting for you.
I got 147.47.
So that means from the date that they sell their product, they are taking 147 days, of which you find that usually this can be bad if you are selling groceries, for example. But if you are selling cars or you are selling furniture, that can be all right. So it will also depend. For you to interpret, it will depend with the credit terms of the entity. Right. Then we've got trade payables settlement period. That's how long you are taking to pay your creditors. All right. The trade payables, we have them here. We'll just take the average. But the purchases we don't have. We have cost of sales here. And we have inventory. But we need purchases. Right. I think you know that cost of sales is equal to purchases, opening inventory, plus purchases minus closing inventory. I think you know from our accounting. So if we change the subject with the formula, we can also find that purchases is equal to cost of sales plus closing inventory. Minus opening inventory. So we can find our purchases. So we can safely say that our purchases is equal to, right, our cost of sales, we have it here, 242,000. The opening inventory will be for last year, the 46,000. And the closing inventory will be for this year, the 122,000. So we'll simply say our cost of sales, 242,000, plus the closing inventory, 122,000, minus the 46,000, the opening inventory. So we'd say 242,000 plus the closing inventory 122,000 minus the opening inventory 46,000. What do we get?
$318,000.
318,000. Right, so would say here our average trade payables would say 119 plus 158 divided by 2. So would say 119,000 plus 58,000 divided by 2 multiplied by 365 over the credit purchases which you found there, 318,000. What do we get? What do we get? I'm waiting for you.
$101.58.
101.58.
58. 58.
58.
Yes.
Thank you. So it's taking them about 101 days to pay their own creditors. So whether it's acceptable or not will also depend on the terms that are granted by creditors in the industry average. Right. Then inventory holding period. That's the number of days that we are taking with our inventory in stock. Right. Average inventory, it will be this one. Then our cost of sales is 242. So say 122,000 plus 46,000 divided by 2, multiplied by 365 over the cost of sales, which is 242,000. What do you get?
One to 6.69 days.
Again, whether it's acceptable or not would depend on the type of product, the industry we're operating in. For example, goods that expire will not require such an inventory holding period. Right. Then finally, they said long-term loan. Now, if they say long-term loan, a long-term loan is not a ratio. They just want the long-term loan, which has got a question mark here. So what you have to do when you are doing such a topic is to find if there is any ratio that involves that long-term loan. Now, if you can see, we're given that the debt to equity ratio is 50%. We know that the debt to equity includes the liabilities. So we can use that one to determine our long-term liabilities. So we can say, so sometimes instead of asking you to calculate the ratio, they can give you a ratio, but they ask you to find one item that also forms part of the formula. Right. So our debt to equity ratio total debt over total equity times 100. Right. Now let's do mathematics. If you can say let the long-term loan X. Right. Our total debt. When we're talking about debt, we're talking about the bank overdraft, the trade and other payables, 119,000, and the long-term loan, those three. And our equity is the capital, the 400,000. Right. So we can say for 119,000 plus 40,000 plus X over the equity, which is 400,000. We can say this is equal to 50%. Right. Then right, we can do our mathematics here. We can just say, sorry, let's remember that this is multiplied by 100. Right. So if we can say here, so we can say 119 40,000 plus 40,000 plus X multiplied by 100 is equal to 50% times 400,000. Remember that if we take a denominator to the other side of the equal sign, it becomes part of the numerator. So if we take this 400,000 to that side, it becomes part of the numerator, right? So then we can say 119,000 plus 40,000 plus X multiplied by 100. Actually, so that remember that it will not show the percentage. So rather we should ignore this percentage and just say 50. So remember that your answer comes is 50. Right, is equal to what? What do we get here? $50 times 400,000, what do we get?
$200,000.
Is what?
Oh, sorry.
I think you will get 20 million here.
20 million, yes.
That will be 20 million.
Yeah.
Right, then you say 119,000 plus 40,000 plus X. Right, if we take that 100 to the other side, it becomes 20 million
20.
divided by what? 100.
Right.
Is that right? That 100 that is multiplied on the left hand side. If we take it to the 100 side, it becomes a divided. So that means we'll get 119,000 plus 40,000 plus X is equal to 20 million divided by 100. We get what? 200,000. Is that right?
Yes.
That means our X is equal to 200,000. The 119, if it goes to the other side, it becomes a minus. The 40, if it goes to the other side, it also becomes a minus. That means our X is equal to what? What do we get?
41,000.
41,000. Which means our long-term loan is 41,000. So you can also be asked to find a figure whilst you are already given the ratio. So you should use your ratio and your mathematics to determine the missing figure. Any questions? Right. If we don't have any questions, then we'll continue next week. Thank you so much and God bless you richly.
Thank you.
And wishing you all the best in all the other exams that you are writing.
Thank you so much.